You're watching the Daily Market Comment for Wednesday, December 14th by Mario Sachikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. A downside surprise in U.S. CPI yesterday fueled bets that the Federal Reserve won't need to raise interest rates as high as previously feared to win the inflation war, setting off a chain reaction of relief moves across global markets. Consumer prices rose by 7.1% in November from a year ago, below the forecast of 7.3%. Declines in energy items, airline fares, used cars, and medical care spearheaded the improvement in inflationary pressures, whereas even rents and food prices decelerated, reinforcing the notion that a new disinflationary trend is in the making. How quickly inflation comes down to its 2% target is a different matter, though, complicating life for Fed officials who are wary of a 1970s-style rolling flare-ups in inflation as the labor market remains historically tight. In the FX complex, the U.S. dollar was the main casualty as traders recalibrated the Fed's interest rate trajectory lower, and wagering that rates won't need to exceed 4.85% in this cycle. The dollar lost the most ground against the Japanese yen and Australian dollar, with the former benefiting from narrowing yield differentials and the latter from the euphoria in equity markets. Looking ahead, traders will focus on the FOMC decision later today. Market pricing suggests the Fed remains on track for a 50 basis points rate increase, in which case the market reaction will be driven mostly by the updated rate projections in the new dot plot and Chairman Powell's commentary. Nevertheless, the outlook for the dollar seems neutral at this stage. A softer Fed profile is bad news, but at the same time, a total bearish reversal in the reserve currency is unlikely, while recessionary risks are intensifying throughout the world. Stock markets stormed higher following the inflation report, drawing fuel from bets of a less aggressive Fed next year and renewed hopes that the U.S. economy might achieve its elusive soft landing after all. However, most of these gains evaporated as the session progressed, with equity traders locking in some profits to protect their books from any turbulence ahead of a litany of central bank meetings. Gold prices shot up to reach their highest level since June, taking advantage of the retreat in the dollar and U.S. yields. Bullion is now down just 1% for the entire year, which is a very encouraging sign, considering the dramatic spike in interest rates and the sharper losses in most other assets. This was a Daily Market Comment here at XM.com.